Welcome back to my YouTube channel. Today I'll introduce valuation of firms. This was a question tested on in April 2023. That was question 24. And before we continue doing this question, if you are yet to subscribe to this channel, please subscribe. For those people who have subscribed, we appreciate so much, because without you, this channel can't be where it is today. Thank you so much. And without much ado, let me go directly to the question. M Limited is currently making a bid for N Limited. The following information has been provided to enable you to determine the various prices that M Limited can offer the stakeholders of N Limited. We have statement of profit or loss for the year ended 31st December 2022. Then we have statement of financial position as of 31st December 2022. Then additional information number 1, currently N Limited has 4 million shares with a market price of shillings 15 per share. Then number 2, the current market value of N Limited's debt is shillings 24 million. Number 3, N Limited financial statements item are expected to grow as follows. Revenue at 10% for the next 5 years. Yeah, so revenue will be at 10% for the next 5 years. So that's the growth rate. Yeah, so I'll change this to percentage. So I'll go to the next item. So we have earning before interest, tax, depreciation, and amortization. Stroke revenue margin is expected to remain the same. So we'll go to where the revenue margin is. It's here. So it was 20,000. So what is the margin which is supposed to remain the same? So we just say equals to, then you take the earning before interest, tax, depreciation, and amortization, and divide by the revenue, because it's a revenue margin. Yeah, and you'll get your percentage there. Let me change this into percentage. It will be 20%. So the margin, the revenue margin is 20%. Roman 3, depreciation stock amortization to grow at the same rate as non-current asset, that is 15%. So let's write there 15%. Then change this into percentage. Yeah, I'll go to the next Roman number 4. Interest expenses about 10% of previous year long-term debt, which will grow at 20%. So here there are two things. Interest expense is at 10% of the previous year long-term debt. Yeah, but the long-term debt will grow at 20% annually. Yeah, so it means that it will grow at 20% annually. Yeah, that's good. That's good information. So I just changed all that into percentage. So you have 10 and 20%. Then retention rate is 60%. That's the retained profit. Retained profit. And they're saying any balance figure and the forecast statement of financial position is long-term debt. That's okay. So the retention rate is 60. That rate is 60%. So it means that dividend will go with 40%. Yeah. Because profit is at profit for the year is at 100%. Then if you are retaining 60, then it means you'll pay dividend at 40%. Yeah. 40%. So we continue. So I'll change this into percentage. Yeah, so it'll give me 40%. So they're saying current assets and current liabilities will grow at 10%. So I just write here 10%. That's the growth rate. 10%. Then we just have to move to change percent. Then the applicable weighted average cost of capital is 18%. So that's WACC. It will be 18%. So I just change this into percentage. Assume that the free cash flows to the firm of N Limited will grow at 3% from year 2020. So that's what we call the indefinite growth. Yeah, so I'll just write there 3%. We'll use it. Don't worry. Yeah, it's 3%. So I'll go to required, determine the value of N Limited using the free cash flows to the firm. Yeah, so before doing the free cash flow to the firm, we have to do forecasting, both for statement of profit or loss and statement of financial position. Yeah, with that information is where now we can be able to calculate the free cash flow to the firm. So this is what I will do. Start with the statement of profits. So just write there forecast statement or profit or loss. I'll bold it. Yeah, then I'll start because now it was a 5-year forecast from 2023. So I'll start with 2023. Then I'll just go to general. Then I'll go to fill so that I can spare on time. Then it's on a row. My step value is 1. Then I'll end at 2027. Yeah, because from 2023 to 2027, those are 5 years. So what I will do next is I'll bold this so that you can see it clearly on your side. Then I'll underline. Yeah, I'll create the bottom border. Yeah, that's what we call the bottom border. Yeah, then from there now, I'll have to copy. I'll copy this. Yeah, just copy this information. Yeah, because I'll focus on through using this information. So just say Control C, and I'll come to Control V to paste. Yeah, so I'll extend that a little bit. Yeah. Yeah. So the values here in thousands. So you will note that. So another thing I'll do here, I'll also do a forecast statement of financial position. Of financial position. Yeah, so I'll do a forecasting. Yeah, so what I will do, I'll just copy this. Yeah, because now I have the years here, I just say okay. Then I just drag up to there. And then I bold. Then I light that. I just change this to general so that they turn on 2 years. Yeah, that's okay. So I'll copy the same. I'll copy the same information and that statement of financial position. So I just copy this. Yeah, you do this to save on time. Yeah, you do this to save on time because this paper is all about time and speed. Time, speed, and accuracy. Then just say Control V. Yeah, that's how you paste in Excel. So I've pasted that. Yeah, so I have everything that is required. I just introduce the bottom border here. Yeah, so I'll start the forecasting. So I'll start with revenue. The revenue was 100,000 in 2022, but for 2023 now it will grow at 1 plus the growth rate. The growth rate was here 10%. So I'll lock it with an F4, then I enter. So I'll go to the second year, and the second year growth rate, I'll take the previous year, which is now, in this case, is now 2023. And I'll multiply by 1 plus the growth rate again, which is 10%. And I'll lock. And I enter. So once I enter that, I'll just drag this all through. Yeah, I'll drag that all through. Then I'll go to the next item and addition of information number 2. They are saying earning before interest, tax, depreciation, and amortization stroke revenue margin is expected to remain the same. So already I've calculated it at 20%. So I just multiply direct. So I just come here. Yeah, because we are not given cost of sales. So I'll just come here and take 20%. Then I'll lock it because it's constant. Yeah. Then I'll multiply by the revenue here. Yeah. So once I get 22, I'll just drag all the way to 2027. Yeah. And with these values, now I can be able to calculate the cost of sales, which I'll take this minus the revenue. so that I get 88, which is true. 110,000 minus 88 will give you 22. So from here, I'm free to drag so that I get these other values. Then I go to depreciation and amortization. Yeah, so depreciation and amortization, I'll pick this value, then I'll multiply by the growth rate. 1 plus, what is the growth rate for depreciation? Depreciation stroke amortization to grow at the same rate as non-current asset, that is 15%. So I'll multiply that by 15% and I'll lock it and I'll enter. Yeah, so for the second year, I'll pick this, multiply by 1 plus the growth rate, which is 15%. It's here. So I'll also lock it once again. Then I enter. Yeah, so once I enter that, I just drag for the remaining years. Yeah, so this I love an EBIT, which is earning before interest and tax. Here I just sum these two. I love 17,400. Yeah, I love 17,400. So I'll go to, and with that, just drag on through, and we have the values with change automatically. So I'll go to interest. Yeah, so under interest, we were told there was information very key under interest. We were told that interest expense at about 10% of the previous year long term, which will grow at 20%. So what will grow at 20%? Is it interest or the previous year's long-term debt? Me think it's the previous year long-term debt which will grow at 20%. But the interest expense at about 10% of previous year's long-term debt. So if you are told that it is interest expense at 10% of previous year long-term debt, then they stop there. Then they go and say previous year long-term debt will grow at 20%. Then it means that it's this interest expense that grows at 10%. Yeah, 20%. So it means that is the interest expense that grows at 20%. Yeah. So let us see how we'll do it. So for this, the interest expense here will be, yeah, so we'll have it is 10% of the previous, so I'll take the 10%. So I'll pick the 10%. Then I'll multiply by the previous year's long-term debt. So the long-term debt, I'll come to statement of financial position, which is here. It is 24. Yeah. That 24, I'll multiply. Yeah, this will have to grow at the rate of 1 plus the 20%. One times 20%. Yeah. Yeah. So let me see. Yeah, so we'll have 2880. Yeah, we'll have 2880. But I want this to be negative. So I'll put a negative sign here for the interest rate. So I'll just enter. So I'll have negative 2880. So my earning before tax will be the sum of these two. So I'll enter that. I'll have 14,520. Then tax was 30%. So this is what I'll do. Let me just write somewhere 30% for tax. So let me put it here so that I can lock it. Yeah, so my 30% is here. So I will just come and pick it. Just come here and pick it. Yeah, come here and pick it and lock it completely so that I can use it all through. And I'll multiply with the earning before tax. But I want to put a negative sign so that I get a negative value for. So my net income will now be the sum of these two. Yeah, so my net income will be 10,164. So my dividend will be, it was 40%. So I'll create a negative sign. Then I put 40%. Then I'll multiply by the net income. Yeah, so I'll lock this, the cell for dividend, the percentage dividend completely, so that when I drag, it will pick. Yeah, so the return profit for the year now will be the sum of these two. So you just come here and sum this two. Yeah, so the return profit brought forward for 2023 is the return profit carried forward for 2022. So just come here. Yeah, what was the return profit carried forward? It was 20. Yeah, in 2022. So just come here and see equals 2. Now I'll sum these two. So it will give me 26,098 as the returned earnings. And this is what I will do. I'll do this. I'll create a bottom border. So let me just highlight this so that I create a top border there. Yeah, top border there. Yeah. So with this now, I have the return profit carried forward. And this return profit carried forward will enable me to calculate, to know the long-term debt. Yeah, so with that, for this, I can't continue with the interest because this interest is 10% of the previous year's long-term debt. And that long-term debt, we are told, is the balancing figure. So this is what I will do. I'll now come to statement of financial position. And I'll start with non-current assets. I'll also do the forecast. So I'll pick this and I'll multiply by the growth rate, which is 1 plus all of the growth rate. The growth rate was, we are told that depreciation stock amortization to grow at the same rate as non-current assets, that is 15%. So I'll pick the 15%, then I'll lock it, then I'll enter. So once I enter, I'll go to the next year, which is 2024. I'll pick for 2023. Then I multiply by 1 plus the growth rate, which was 15% here. So I also lock it completely. Then I enter. Let me just say yes, enter. No, sorry. So just come here and say 64 times bracket 1 plus the growth rate. The growth rate is 15% here. So just click F4, then I enter here. So the value will change. So when I drag, it will copy all the way to 2024. Then I put current assets. I'll go to current assets. So my current asset will be the rear. See here. It's 24. But it also has a growth rate, which was 1 plus. We are told current assets and current liabilities will grow at 10%. Yeah, so I'll lock it. Then I enter. So I'll go to the next year. I'll pick this. Then I multiply by 1 plus the current assets and current liabilities. 10% F4. Then I'll enter. So I'll enter. Then I'll drag. Yeah, these values will change up to 2027. So I'll have the total assets. So I'll say equals to the sum of current and non-current assets. So I just sum these two. Then I'll drag all through. So I'll have these values. Let me just bold them so that you can see it clearly on your side. So let me create the top border here. Then I'll create the thick bottom border. Yeah, so these are the values we have. Yeah, and you know that total assets should balance total capital and liabilities. So I just come here and say equals to, I'll put that there. Then I'll drag. Yeah, then I'll also bold this so that you can see the values clearly on your side. So I'll create the top border here. then also include the lower, the thick bottom border. Yeah, so this is supposed to balance. Total assets should balance with total capital and liabilities all through the forecast years. So I'll go to ordinary share capital now. And on additional information, there's nowhere where we're told there was issue of any shares. So the 16,000 will remain constant all throughout the forecast period. So I'll click this, then I drag. Yeah. So the retained earnings now for 2023, we have it here, retained profit carried forward. So I just pick it, put it there. So but with that, I'll be able to calculate the total equity. So I just sum these two. Yeah, because already I have the retained earnings. Yeah, so the long-term debt, we don't have it, and we're told that is the balancing figure. So I'll just come here and check for the current liabilities. Yeah, and forecast for the current liabilities which we have. So it is 20, but they were growing at the rate of 10% also. So we have 1 plus, and I'll lock it. Yeah, you lock it. Yeah, for this we are still doing forecasting. Lock it. Then for the second year, I'll pick this, multiply by 1 plus the rate, which is, it's here 10%. So I'll lock it again, so that when I enter, so it's 1 plus the rate, which is here is 10%. So I'll lock it F4, then I enter. I don't know why it's giving me 490. Let me see. So 1 times bracket 1 plus the growth rate, which is 10%. Yeah, then I'll put a bracket, then I'll enter here. So once I enter that, I'll just travel through up to 2027. Yeah. So we don't have total liabilities because already we don't have the long-term debt. But we know that for us to get the long-term debt, we're told is the balancing figure here. So I'll just say equals to, and I take the total capital and liability under this year, then minus the total equity, then minus the current liability, so that I can be able to get the long-term debt. So I just enter. Yeah, so my long-term debt there will be 267002. Yeah, will be 267002. 670. So that will be my long-term debt. So I'll be able now to calculate the interest here. So my interest here will be equals to, it was 10% of the previous year. So I'll just say 10% of the previous year. So we pick 10%, where is it? Rate for interest. The interest expense at about 10% of previous long term. So I'll pick 10%. Yeah, and let me just lock it. I can lock it or leave it. Yeah, but I'll multiply that by the previous year's long-term debt. Yeah, but I'm told that this was growing at the rate of 1 plus 20. 1 plus 20%. Yeah. Yeah, which will grow at 20%. Yeah. So I'll pick that 20 again there. Then I put the bracket, then I enter. So I'll have 32.05. And I want this value to be negative. So I'll put a negative there. So yeah, so once I enter, yeah, you know, the goal is to get the retained profit so that you can know the balancing figure on the long-term debt, because we're told that the long-term debt is the balancing figure. Yeah, so this is what I will do. Because now I have interest, I just drag all through. Even tax, I'll drag this, I'll drag net income. Dividends, I'll also drag because I locked the formula. Then return profit for the year, I'll also drag. Then this also I'll drag because it will copy. No, sorry, not yet. Yeah, so for this, I'll pick, you know that the return profit brought forward is the return profit carried forward previously. So this one. Yeah, so that when I drag this, it will give me 32,695 as the return profit. And that's what I need in year 2024. So I just come. Yeah, alternatively, if I drag, let me see if I drag, it will copy. Yeah, it will copy the 32,695 here. Yeah, so that I just come here and drag that. Yeah, so when you drag total equity, I can just drag this and have the value there to be 30,205. Yeah, so the value, the long-term debt is now 30,205. So I'll just come back because that's what I was looking for. So I'll just come back to interest again. And we're told that interest was 10%. Yeah, so I just come here. Yeah, it was about 10% of the long-term, which will grow. Yeah, the interest will grow. It's the interest that will grow, not the long-term debt. It's the interest that will grow at 20%. Yeah, it was about, but it will grow. So I'll multiply that by, I'll multiply this 10% by the previous year. The previous year long-term debt here is now, for 2025 is now 2024. Yeah, and this will have a growth rate of 1 plus the 20%. 20%, yeah, they will grow. Yeah, the interest will grow 20%, maybe because of inflation. Then I'll put a negative sign because I want it to be negative. Yeah, so I'll have that value there. So once I have the interest there, I'll just drag. I'll drag this. I'll drag this. I'll drag this. I'll also drag this. And I'll also drag this. You see, we'll now realize that return profit brought forward for 2025 will be 32,695. Let me drag. Yeah, you can see it has copied this automatically. Yeah, helps you save time. Then when I enter, now my return profit carried forward for the year is 39,79. So I just come to return profit and I'll just drag that. So if I drag, it will give me 39,798 there. Then I'll do the same here. Then I'll do the same for long-term debt. Yeah, you see, yeah, you see how I'm saving time. So it's 37,115. Yeah, the balancing figure. So I'll take the 37,115, then take the 10% of it, because interest was 10% of the previous year. So I'll take 10%, but I'll put a negative sign here because I want the interest to be negative. Then I'll multiply, sorry, I'll multiply by the previous year's long-term debt, which in this case is that. Then this will have a growth rate of 1 plus 20%. Yeah, that was this 20%. Then I'll close the bracket. Then I enter. So once I enter, I'll just drag. Then we'll have return profit for the year, the same, you just drag. Return profit also, you just drag. It will give you this 39,798 here. So I just drag this. Then I'll drag that. Yeah, so that when you come here, under return profit, you just drag. Yeah, you can see it's from 7 to 87. What is here? Yeah. The Excel is programmed in a way that when you drag, it copies your pattern. So drag that. Then when I drag this, it will give me a new value, which is the long-term debt, which I was looking for. So I just come here again and take the 10%. So I start with a negative sign. And I go to 10%, which was the interest rate, then times the previous year. My previous year long-term is this now. Yeah. Then this is supposed to grow at the rate of 20%. So it's 1 plus 20%. percent. Then I just close the bracket, then I enter. Yes, I'll have that value there, 5471. Then here I just drag, there's nothing much to do. Yeah, the work, it makes your work easier. It makes your work easier. Make your work easier. So you just do the same all through. Yeah, yeah. And by then I'm done with forecasting for profit or loss. So let me do the same to retained. Just drag that. Also drag this. Yeah, and you're done. So what I'll do here now, I'll look at the total liability. So I'll take the long-term debt plus, because that was what was missing, plus current liabilities. So there. So I just drag this on through. Yeah. So for me to confirm if it is balanced, that yeah, you will add all this and it will balance. You get to 9,800. So the long-term debt is already there. Yeah, long-term debt, the balancing figure is already there. So yeah, that we were just doing forecasting because you can't go to free cash flows without knowing the actual, the net income, the depreciation, you must know them. So I'll now go to the free cash flow to the farm. So I'll do it here. So write free cash flows, the farm. The farm is also called discounted cash flow. There, I will find that examiner is asking you to calculate the this discounted cash flow to the farm. So this is what we'll do. So this is the formula. The formula is the formula is net income plus depreciation and amortization minus capital expenditure minus changes in working capital minus any other change in any other assets. Yeah, a change in any other assets. So this is what we are going to do. So we'll do the from 2023. Yeah, because what that is from 2023. So I'll do that. Then I'll drag. Sorry, let me undo this. Let me start here so that I don't move to this space. So I'll just copy. Yeah, so I'll put general. Then I'll bold this. Then I'll create the bottom border. Create the bottom border. So we start with the net income. I told you that the formula was net income plus depreciation and amortization minus capital expenditure minus changes in working capital minus other assets. Yeah, that's how you calculate the free cash flows to the farm. So I'll start with the net income. So just come here, check. Yeah, you just copy. So I'll come here and pick the net income. So once you have the net income, you just pick the values that you forecasted. And that's why forecasting was key. So I'll pick this. Then I'll drag this on through. Then the next item is that I'll have to add the depreciation and amortization. Was that depreciation and amortization? Yeah, it's here. So I'll pick it. Let me extend this. Yeah, so here you just copy. When you have the values, it's easier. You just pick them. But you recall that for this now I have to add, but the values for depreciation are negative. So I'll create a negative sign before. Yeah, so I've changed this into positive. So when I drag, all the values will change into positive. So the next one, the capital expenditure. Yeah, so just write capital expenditure. And this capital expenditure is what it's all about what you you acquire, yeah, your acquisition throughout the non-current assets. Yeah, so this is what we will do. Yeah, so you look at the trend, was there an increase? Huh? So for non-current assets, there was an increase all through. Yeah, so it means that there were acquisition. Yeah, there were acquisition. So it's just like the cash flow. Yeah, so it means that if they were increasing, if the book value, there was an increase, so it means that there was acquisition. Yeah, so you subtract the changes. So this is what I will do. This equals to, this is how I'll do the changes. So I'll pick 64,400, then minus, yeah, for the previous year it was 56. Yeah, so then this is what I will do, because I want it to be negative, because I'm subtracting it. So I'll put a negative, I'll put a bracket here, and also put another bracket here. Then I say equals to, then the negative sign. Yeah, so once I subtract what is in the bracket, yeah, so I'll have 8,400. That's the capital expenditure. So we spend 8,400 in 2023 to acquire new assets. Yeah, so that's an expenditure. So it's a negative cash flow. I think you understand that, because you used money to purchase an asset. So when I drag, the values will change automatically. As you can see, this N25 minus G25, 0.25 minus, then undo this. No, it can't be that way. Let me undo that. So I'll go to the second year, and I'll do the same, negative bracket. And now I'll pick for 2024 minus that. Yeah, it's 2025. Yeah, that the other one was not correct. Then I'll enter. Yeah, so I'll have 9660. So let me try and drag here if the values will be there, will be reasonable. Yeah, I think these values are now okay, because you can see this N25 minus 0.25, then P25 minus 0.25. No. So I'm supposed to do that one. So let me undo. So I'll just do them single-handedly. So just equals to the negative. I'll pick this 2025 minus this 2020. So it will give me 11. Oh no. So let me drag and see. So this is 12 of 775. So it's telling me that's P25 minus 0.25. Is it correct? Let me see. P25 is true, minus 425. Yeah, that's okay. That's okay. So it means that this is now okay. Yeah. Even this is P25, Q25 minus P25 is okay. Yeah. Q is this then. So that's okay. When you drag, that's okay. It has been copied. Then the other one is changes in working capital. And the changes in working capital, according to your knowledge from cash flow, is all of the changes current assets and current liabilities. So let's start with the current assets. Start with the current assets. This also changes. So I'll come here and I'm supposed to subtract it. Yeah, the changes in working capital. So let me see. Was it positive or negative? So let's come here and say equals to. When you look at the trend, the current assets, they're increasing. Yeah. So it means that we are using money too. So it's a cash outflow. So I just take 26, just equals to negative, because I want to drag. Take 26 for this year. Then the previous year it was 2024. And I just enter. So now 2,400. So I'll do the same for the second year. Then I can be able to drag. So see to the negative. Yeah, because when you are buying, you are buying inventory, you are spending money. So that's a cash outflow. So I will pick this and I'll subtract this. then I enter. So from there, now I can be able to drag all the through. Yeah. So the next thing under working capital is the current liabilities. So I look at the reactions, current liabilities. So I'll go to current liabilities. As you can see, under current liabilities, there was also an increase all through. So it means whenever there's an increase in current liability, then it means that you are not spending money. Yeah, in fact, we are getting money. It's an inflow. It's an inflow. So this is what we'll do. Will be positive. So I just say equals to. I'll pick this minus the previous one, which was 20. Yeah, then I just enter. So I'll do the same for the second year. Then I can drag. So I'll have this minus this. Yeah, so I'll have that minus that. Then I enter. So just enter. Then now I can drag. Yeah, this positive. This positive because it's a cash inflow. Just a minute. Do that. Okay, so let me go to the next one. So I'll have 24. How comes this 24, 24, 24? No, this can't be 24, 24, 24. Let me see where we go wrong. Current liability was 22. No, let me do a correction here. So after this, we add that. Then, yeah, once we do correction, everything will have to change. Everything will have to change. Yeah, things will change. The values will change automatically. So we have current liabilities. And how did we calculate this? Sorry, let me not say equals. You can see it's 24, 24. It can't be stagnant. So this is what we are going to do. I think there was a mistake here. So we calculated this by the growth rate. Then this was this. 1 plus G49. Yeah, so I didn't lock this here. That was the mistake. So let me lock this with an F4 and I enter. So once I enter, let me just drag it. Yeah, so when I drag it, these values will change automatically. The values will change automatically. So here, under total liabilities, we'll have this plus this. So we'll have this. Then when I drag, yeah, you just drag that and you will get the values there. So it's correct. Yeah, you can see these values have changed. Yeah, that's why I was not, yeah, I was wondering. So with that, I'll have now to do the changes once again. So let me delete this. I'll start here. So the change for 2023 will be 2023 minus, yeah, and I say it's an inflow, minus 2022. Yeah, when liabilities increase, then that's cash inflow. So I'll do the same to 2024. I'll subtract this. Yeah, up to that point, I can just drag and the values will change automatically. Yeah, you can see the values have changed automatically. Yeah. So it copies the formula. So after that, changes in working capital. Then other assets. Were there any other assets? There was no any other asset here. We only have non-current and current assets. Yeah. So with that now, we'll now have to calculate the free cash flows. And we'll be able to calculate free cash flows. We calculate the free cash flows. So come and say FCFC, free cash flows. It equals to, it's just the sum, just sum everything. Yeah, then you drag this. So once you drag this, we will have what we call terminal value. So what I will do here, I'll just create a top border. Then I'll have a terminal value. Terminal value. Yeah, so the terminal value, this is how you calculate it. Yeah, it is, you take the final value, which is here. Yeah, then you multiply by 1 plus the growth rate. The growth rate, we are told that in 2028, it will grow at the rate of 3%. So you pick this 3%. Then you put a bracket. Then you divide all this by WACC minus the growth rate. So the WACC was 18% here. Then you subtract the 3% with the growth rate. You enter. So you have your value there. So that you have the total free cash flow here. Total FCF. So I'll just equals to, I'll sum these two. Sorry. So this is what I will do. Now the total free cash flow will be, yeah, just pick for 2023 it will only be this. Then I'll just drag this all the way up to 2026. But for this, it will be the sum of these two. Yeah, so you can just add this plus this. Yeah, so this is the total free cash flow. So this total free cash flow will be enable you to know the what we call the enterprise value. The enterprise value. So let me just borrow this. Sorry. Yeah. So after that, let me calculate the enterprise value. Yeah. So this is what the examiner was asking. Yeah, the enterprise value. So the enterprise value, we just calculate the NPV, the net present value. So just say equals to NPV. Then the rate is the WACC. Then pick the values. You just select everything here. Then you enter. Yeah. So you'll have the enterprise value at 35,119. So when you are told to advise, you will have to advise whether to, yeah, because this was a bid to take over a farm. So if you are told to advise the farm whether to take whether to advise, prices. So you check at the interest, what you call the intrinsic value. Yeah, the intrinsic value will be equals to the enterprise value divided by the number of shares. Yeah, so the shares we said was 4,000. Yeah, we are told that currently Unlimited has 4 million shares with the market price of shillings 15. Yeah, so if it has 4 million shares, let us see what is the current price of shares of this company, because there are 4 million at 15. So it means that that's almost 60. Yeah, that's 60 million. So let me divide this by 4,000 because our values were in 1,000. So the intrinsic value will be 9. So it means that the value of each share should be 9 shillings, not 15 shillings per share. So if it was to advise M on whether to make a bid for M, you will advise them not to make that bid, because the intrinsic value, the value of shares in N are exaggerated according to this information provided. It's supposed to be 9 shillings, not 15 shillings. So the shares were overvalued. So the best advice to give an investor or to give M Limited is not to take over the company, because the share price was overvalued. Yeah, that's how you're supposed to do that question. Yeah, that's how you're supposed to handle that question. So thank you so much for your time. Until next time, bye bye.